Now let's continue with Chapter 3, and this is the second part of Chapter 3. In the first part of Chapter 3, we were talking about the GAAP. It's GAAP, Generally Accepted Accounting Principles, which relate to revenues and expenses. Basically the rules that tell us when we can record revenues and expenses. We said that revenues can be recorded, and we call these revenue and expense recognition principles. We said that we could record our revenues when we have earned it. For services, it means significantly or substantially all the services that we are obliged to provide, we have done, we have provided. Or if it's in the case of products, that the products are no longer with us, that they've been delivered, or in the example we gave of Walmart, the customer has left the store with the product. When this happens, we get to call it revenue. For expense, we said two things are very important. We used the thing up, and we said that we should try to match the expense up to the revenues. So in the time periods in which we're showing our financial statements, our income statements specifically, we should be showing those expenses related back to those revenues. This is very important. In the first learning objective, we talked about what operating transactions were and how these things show up on the income statement. Under various categories, we have revenues and we have expenses. And generally, we talk about the fact that we have to incur the expenses in order to be able to generate the revenue. Now we're going to skip ahead and we're going to go and cover our learning objectives 3 through 5, in which we go back and we use a kind of a familiar format where we analyze transactions, we determine how we're going to record those transactions, and by using the accounting equation, we're going to come up with journal entries and use T-account analysis. So it's something similar to what you've had before. In Chapter 2, we were looking at the balance sheet. In Chapter 3, we're looking at income statement. So we're concerned with revenues and expense accounts. We will then prepare what we call an unadjusted trial balance. The last thing we're going to do is evaluate net profit margin, and then we're going to talk a bit about income statement limitations. So let me end this show for a moment and get us to where we need to be, which I think is slide 13, starting with slide 13. Where we're going to start off is analyzing, recording, and summarizing the effects of operations. The first thing that's a little confusing to students once we start talking about stockholders' equity is that when we look down here at revenues and expenses, we see that revenues normally have a credit balance and expenses have a debit balance. And when we look at this, what we are saying really here is that these income statement items, revenues and expenses, are really a part of the equity section. And we know that these two items are a part of the equity section because they fold up into retained earnings. It's helpful if we look at this from this perspective and we say, okay, I know that the things on the right generally have a balance which is a credit balance, and that the normal side of it, the normal balance in the account should be credit and the increased side should be credit. But when I look down here at the expenses, I see that this is not the case, it's a debit. So what's going on? Well, the helpful approach to this is to think about revenues as increasing net income and increasing retained earnings, and so that they also then increase stockholders' equity. However, when you look at expenses, expenses do not increase net income. In fact, expenses decrease net income, decrease retained earnings, and therefore they are decreases in stockholders' equity. So an expense naturally reduces retained earnings, reduces stockholders' equity, And because everything to the right, which is in liabilities and stockholders' equity, has a normal increase, which is a credit, see all these credits, therefore if we have something that does not increase stockholders' equity but decreases it, which is what expenses do, then we should call it a debit. So perhaps this will be helpful. Now the other thing I would suggest, and I have it on another slide, is that you just memorize. Revenues are credits. Revenues are credits. Expenses are debits. Just memorize that. Revenues should almost always be recorded as credits. Expenses should almost always be recorded as debits. And in this class, that's what you are going to see. Just assume revenues are credits, expenses are debits. And if you can just memorize this, it makes your life so much easier. It really does. While we were talking about that, I guess it'd be a good thing in passing, going back to this previous slide, if we also talked about the retained earnings statement, because in the restatement of retained earnings we know that revenues increase, expenses decrease, but what's the other decrease in the retained earnings statement? I'm going to listen. I'm going to listen hard. I know there's someone out there that's going to say the decrease is going to be dividends. Yes. So dividends also will have a natural debit balance. So expenses tend to be debits, and dividends, when we show dividends, will also show up as debits. Yeah, let's go through some transactions. Just like we went through the transactions for the balance sheet, we go through transactions for the income statement. They sold 3,000 of games on their online store. And these games are going to be sold for cash. Again, revenues are credits. Now the other thing is going back to our relationship in which we said if assets increase, then we need an increase on the other side, or we need a decrease here so it offsets the 3,000. We know this is revenue. We know revenue flows into the statement of retained earnings. Revenue increases net income. Revenue increases the statement of retained earnings. Retained earnings are a part of stockholders' equity. So we need an increase over here. We need stockholders' equity to go up. It shows up as a credit. And that makes our world wonderful. Again, it's far easier, though, not to have to go through all of that. And just to remember, revenues are what? Credits. They are credits. So it gets recorded this way. And this plus an R means it increases revenue, also increases stockholders' equity. And when we see this, we are keeping track of our cash account, and we're seeing cash going up. So cash is going up from selling these games at our online store. Now, I just want to think a minute about this, because I think this is not quite right. If they are selling these games in an online store, would they be getting cash? The only way they would be getting cash is if someone were putting these on their debit cards and it was hitting immediately, because if they put it on their credit cards, they wouldn't get cash in the same day. There would be a bit of a delay before the company got the cash in. So I'm thinking this is not quite right. We should probably mark out that online store and just say they sold 3,000 of games at their store, right? Now, receive cash for future services. This is a bit tricky because we have not done the work. Our revenue recognition rules from the first PowerPoint of this chapter said, unless we've done the work, we can't record the revenue. So instead we owe them. We owe them services in the future. And because we owe them, you naturally think of an IOU in terms of cash. You think, well, if you have an IOU, you owe someone cash. You're going to pay them cash in the future. It's not the case here. Instead of us owing them cash, we are going to owe them services. But it's still a liability. So what we do is we have a liability which we record, and we record the cash coming in. Now, after we have done the work, after the work has been provided, then we can call it revenue. Right now, we can't call it revenue. And one example of this early payment, where people pay us cash but we don't do the work yet, is gift cards. Gift cards are an interesting thing. You probably have received gift cards for Christmas gifts, or maybe for your birthday, or maybe you've gone into a store, and even now the supermarkets sell gift cards and you can give gift cards to people. Well, give them a greeting card, and inside give them a gift card to go to Red Lobster, or another favorite restaurant that they really like. Or you might have a gift card to Amazon or another one of their favorite stores. Well, when this store, be it Amazon or whatever store it is, sells these gift cards that you've purchased for your friends, they don't get to call it revenue because they have not provided anything. They have not provided the services. Instead, they call it something called unearned revenue. Unearned revenue is not a revenue account. It is a liability account, and it represents something that, say, Amazon is going to have to provide in the future. Because when you come in, or your friend comes in that's received this gift card, they're going to use the gift card, and then will it be called revenue. So for the time being, we create this account, and it's called an unearned revenue account. Now, companies have to keep track of their gift cards. They have to keep track of what the balance is in their gift cards, and they have to keep track of the fact that customers come in and use the gift cards, and the gift cards go away. The interesting thing about gift cards is some gift cards just get lost. And what do we do with lost gift cards? It's not hanging out there as a liability forever. This is something that will come up, and we'll talk about it when you get in your upper division classes, but it's an interesting concept about what happens with the gift cards. For now, Amazon or whoever issued this gift card is going to have a liability to the customer until the customer actually comes in and gets those products using the gift card that you gave your friend. So unearned revenue is not revenue. It represents the value of services that you, or I could say the company, will be providing in the future because the company was paid early for these services. Unearned revenue is a liability. As I say up here in a big font, it's another thing you need to memorize. So let us memorize that revenues tend to be, credits, and expenses tend to be debits, and unearned revenue is not revenue, but it is a liability, and it becomes revenue when the services are provided or the goods are provided. In this case, we are going to have this company, our company, Sonic Gateway, selling apps on credit. And so they're going to sell, and selling means revenue, and they are going to sell the apps. The apps are going to leave. They're going to be in the possession of the customer who has purchased the apps, so we have revenue. Definitely have revenue. But it says up here on credit. Now, just like on account, which is an account payable, on credit means an account receivable. So what you need to do with this one is record revenue as a credit always, and record revenue as going up and increasing stockholders' equity, because revenue increases net income flows into retained earnings is a part of stockholders' equity, but also we have this side going up for the revenue. Obviously, we need our assets to go up on this side so things are in balance. And the assets will go up on the debit side because assets increase as debits, and will go up by $9,000 in an account called accounts receivable. The account receivable here represents an amount that the customer is going to have to be paying in the future. The whole accounting system is going to have to keep track of which specific accounts these are, who these customers are that owe us, because we're going to have to send them bills. We're going to have to remind them that they owe us. It's no good for us to sell our products and receive accounts receivable if we never get the accounts receivable turned into cash. So the customers need to pay us, so that in the end we have cash. We need cash. We don't need promises from people. We need cash. So here, we would rather have had the cash in instead of accounts receivable. Why? If we get the cash in, we have the cash to spend on buying more merchandise for sale or providing more services, which in turn we can do, and then we can get more cash in. So it's that cycle. It's the operating cycle we were talking about earlier. If we get cash in, then we don't have to go to the bank and borrow money and pay interest. So that's another good thing. The other problem with accounts receivable is sometimes the customers don't pay us. They move away without paying. And some customers just commit fraud. And I say they commit fraud because they come in and they put things on account and they have no desire or no intention of ever paying us. I call these people deadbeats. And we can't really eliminate all these people. This is a topic we're going to return to later in the chapter, but we just can't get rid of these people. There are always some people who will take advantage of our company and our goodness, and they will just not pay us. They'll take our merchandise and not pay us. So wouldn't we rather have someone pay in cash than not risk these people that won't pay? And wouldn't we rather have cash so we can go out and buy more merchandise, make more money? So two very good reasons why we'd rather have cash instead of accounts receivable. Now we're going to go through some more transactions, and the thing I want you to remember is that we are in the month of September. So let's remember, we're in the month of September when we go through these. Now, we had an account that was out there that was a receivable, and it was from Apple and Google, and they decided to pay us. So Apple and Google, which I don't think they're probably deadbeats, right? And they go through and they pay us. What's going to happen here is we are going to get cash in, and the cash is going to replace an accounts receivable. As we said a moment ago, this is a wonderful thing because now that we have the cash, we can go out and buy more products. We can provide more services and incur more expenses related to providing the services, and in the end make more net income, right? Generate more cash, etc. It creates another cycle. This is an asset swap because what's happening is the accounts receivable is going away and the cash is coming on our books. I call this an asset swap. So one asset goes down, another asset goes up, all of it's showing up on the left-hand side of our large T account or in our accounting equation. Again, you're keeping track of your cash. You're also keeping track of your accounts receivable. We had 9,000 in accounts receivable in the previous transactions, and now we've received 8,500. So what is our balance in accounts receivable? Again, the rules are debits minus credits equal balance, and you put whichever of these is a greater amount will be where the balance goes. So 9,000 minus 8,500 is 500, which will now show up on the debit side because 9,000 is greater than 8,500. The 500 shows up over here. So now we have a balance in accounts receivable of $500. We are still owed $500. Now the wonderful thing about all of this, as I've said previously, accounting majors really like this, is that we have a running total of our cash account. It's not easy to see what our balance is when we use this T account approach. If we were looking at the ledger, it'd be easy to see what our balance was because we'd be keeping track of it. But you could go through and you could add this column here and you could figure out what our cash account balance is. Just similar to what we have in checking at the bank. Over here, we know how much customers continue to owe us. They continue to owe us the $500 we talked about. So after we book or after we record this transaction, we have both of these accounts that are in balance. And it's just a marvelous, interesting, wonderful thing. And it's what happens with this dual accounting system. Well, the customers will not work for nothing. I mean, they have to be paid. And we would like to call this an asset, but the truth of the matter is that every 2 weeks, every month, you're paying your employees for their work that they have done in that previous time period, and so you don't have an asset left. You're actually going to be using up your asset by paying cash. You're going to be cutting them their paychecks, which is going to be represented here as a reduction in cash, and it's going to show up in salary and wages expense. Now this is expense, and an expense, a plus expense, and an expense actually reduces stockholders' equity because it reduces the net income, which reduces retained earnings, etc. But as I said before, the easy way to go on this is remember that expenses are debits. Expenses are debits. And on the other side, we're going to use up our cash, and to use up cash, to reduce cash, is a credit. Again, you get a situation here where now our cash account goes down, and we are going to start showing expenses. Now, going back to the matching principle, these employees, I'm sorry, I'm used to having student employees. The employees here work during the month of September, and I said before this is September. So when we prepare the income statement, we're going to have our revenue for September, we're going to have our expenses for September. In this case, the expenses for September are those wages that these employees worked in September. It works out rather nice. Now, we're going to pay our rent. Sometimes we are required to pay rent in advance. I don't know how many of you pay rent, but some of you may be may have apartments, and you may be been required in the beginning to pay this month's rent and next month's rent, and they're using it as a security deposit. That's what's happening here. On September 1st, Sonic Gateway is required to pay $7,200 in advance. They're paying for this month, September. They're also paying for October and November. Now, it would not be appropriate for us to call this expense. We cannot consider all the $7,200 as expense, because the matching rule says when we're preparing our financial statement for September, we should only have those expenses related to September on it. So September's business should have September rent in it, and October should have October's rent expense in it. November should have November's rent expense. So basically what we would need to do is we need to divide the $7,200 by 3, and we need to put our amount of rent expense, a third of it in September, a third of it in October, and a third of it in November's income statements. So each one of those 3 months gets a third of the total amount of rent that we're paying. However, we are also going to have to pay all the cash now, so we know what's going to happen is our cash account is going to go down by $7,200. So what do? Well, temporarily we are going to call this another asset, and we're going to call it a prepaid rent. Now, it's prepaid because it's paid in advance. And why did we not say that prepaid is only for October and November, and that the 1/3 of it is an expense right now? Because it's September 1st, and our financial statement will be prepared as of the end of September. Therefore, at this point in time, we are going to say that all of this is prepaid. This is another asset swap, as I say over here on the left. So we create it. And the cash account is getting hit hard, $7,200, and we're creating a prepaid rent. This represents the rent expense for September, October, and November. But it's not called expense yet. Right now, it's a prepaid. We also put sidebar ads in September, and we got a bill that's going to be paid in October. So the ads are going to be in September, and we're going to pay it later. So we are incurring a cost that it's going to be paid later. Well, this is a little bit tricky because there's no cash flow right now. We're not paying it now. However, since this is for September, and you can see it says displayed Facebook site ads in September. This is going to be an ad which we placed, and it's for September's business. We want to make sure that it shows up in our income statement as September expense. So an expense again is a debit. So we're going to debit advertising expense, and we're creating a payable. Now in October we'll take the payable away and we will pay for it with cash. So this liability here is going to go down, and the asset over here is going to go down by the same amount and will be in balance. I haven't really been talking about being in balance. Perhaps I should, but with this transaction you can see both of these are on the right hand side. They, like when we have an asset swap, one goes up and one goes down. Here we have two transactions that are hitting the right hand side of the accounting equation, one going up, one going down, and the net effect is 0 on the right. So here we have our advertising expense showing up for this month, and we have accounts payable increasing by $500. So now we're up to $10,700 that we're going to have to pay. We said accounts payable before was a current account, and I think I said it usually has to go away within the next month, so we're going to think about this. We're going to have to come up with $10,700 to pay out probably in the next month. Sometimes our bank will transfer amounts. I don't know if you have this set up with your accounts or not. I've found in the past that a lot of students do have it set up so that their utilities are coming directly out of their bank account. That's the same thing as cutting a check. I just want you to know that. It is the same thing as cutting a check. Alright? So whether you are cutting a check, writing a check out, or whether it's coming directly out of your bank account because you've made some arrangements for it to be paid. Some of us do that with our credit cards as well. When you have this kind of a setup, you may do it for your rent. When you have this kind of a setup, it's the same thing as cutting a check. And in this case, this expense is for utilities used in September. So it's not a prepayment of anything. It's something that actually occurred in this month, within this month, for our utilities. Therefore, expenses again are debits. Cash is credited to take it down. We started cutting these checks. Goodness gracious, we're spending our money, aren't we? And so our cash account's going down again, and we're recording expense, which will show up on the income statement. After we've done all of this, we can go through and we can check our balances. We checked our balances before on our trial balance when we were just doing the balance sheet transactions. Now we can go through and do this again, and we call this the unadjusted trial balance because we don't have adjusting entries yet, and we're going to talk about those in a minute. You're going to see some interesting things happening here. Just like last time, you know, well, first of all, let's look at the header. We put the name of it, we put what this statement is, and then we say what the date is. And this is a point of time, so it says, at the end of September, this is how our account balances look, okay? Unadjusted before the adjustments. You look at this, and remember from last time we said, these all are assets, they should have debit balance. These, now we have an unearned liability. We didn't have that one before. These three here now are liabilities, credit balances, and common stock is also a credit balance. Retained earnings does not have a balance yet because we don't have our net income in there yet. Right now we have revenue, which is a credit, and yes, it's a credit balance. And then we have these expenses, which has come off of our transactions we just had. I do remember we paid our employees. I remember we had utilities, and I think the utilities might have come directly from the bank. And I think I remember that we had advertising expenses for an ad that was placed. So this is really the standard form where we start with the balance sheet accounts at the top, then we put the income statement down below. Remember from the previous PowerPoint, the double lines mean things agree. We want debits to equal credits, and that's the case that we have here. And these account balances, by the way, we could go and we could look at our ledger accounts. Now they're calling this a ledger account, and this is not really a ledger account, is it? It's a T account. A ledger account would show the balance after every transaction, and we said before that looks more like a little index card. And so in this case, it's not really the ledger account, it's a T account. Whether we went to the T account, whether we went to the ledger, these balances are coming off of these ledger accounts. And the ledger accounts are coming, these transactions are coming off of the journal entries, which we did when we went through the transactions. And the transactions represent all these letters that we had on our previous slides where we numbered our transactions. So with revenue, let's talk about revenues, just reviewing all this stuff. If you receive cash before you do your work, you have to call it a liability. And then when you do the work, you call it revenue. Okay? So if this is the point where you get the cash in, you record the cash coming in, you call it an unearned, which is a liability. Once you do the work, which is at this point right here, this is what the graphic is saying, you're going to call it revenue. This is further explained in Chapter 4. Now, if you get cash at the same time as revenue, there's no problem because you can record the cash, you record the revenue, because you have earned it. So whenever we say we earn it, you record the revenue. Whenever you earn it, you record revenue. That's the rule. Now, you could do the job and get the cash later, in which case you have an accounts receivable, which is later converted into cash. We said we didn't really like this, did we? We don't like it for several reasons. We don't like it because there's a potential for these customers to become hard to reach, deadbeats, people that try to defraud us and not pay us, and we would really like to have the cash early. The best situation for us is this one up here, where we get the cash before we've even done the work. If we've done this and got this cash in early, we can take that cash, we can go out and we can buy more merchandise which we can sell, or we can apply it by maybe hiring more employees or speeding up our production or doing something with the cash. We like that. And the alternative, if we need cash, is to go to the bank and pay interest. As you see with all these transactions, there's no interest recorded anywhere. So why wouldn't we want the cash in early? So if I were a business person, I would want 1 or 2 to happen over 3. But I can tell you that a lot of customers require that they not pay you at that moment in time, and a lot of companies prefer to bill their customers, so it doesn't always work that way. Now let's look at expenses. An expense rule is using up. It's also matching. So whenever you see using up, that is when we record the expense. If it happens that you pay for something before the expense happens, say we prepay our rent, we call this a prepaid, we call it an asset. So we prepay our rent. We could also be required by a utility company to prepay an amount early. If they don't really know us and we're new to a community, this sometimes happens. That's a prepaid. Now, if we're using up benefits and paying for them at the same time, then this is an expense transaction happening at the same time as the cash. Again, on this first one, it'll be explained a little more in Chapter 4. If cash is paid after the expense is done, we create an accounts payable and we pay off our accounts payable. Now, on the revenue one, we said we really like this one up here with revenue because we are receiving cash early. I'll tell you what we like here. If we are paying it out, we want to wait as long as we can to pay it out. because again, if we have cash, we can go out and use the cash for other purposes, and we can also avoid paying interest. So in this situation, from a business perspective, we would rather put things on account and pay them later, which is what happens in 3. And we covered this discussion of this accounting in Chapter 2. We will be covering this a little more in Chapter 4. Profit margin is the same, net profit is the same as net income. And profit margin has to do with the relationship between income and revenue. And what we're looking at here is we're comparing net income to revenue. So how much of revenue dollars is net income is basically what they're saying. Our revenue in this instance is $12,000. You can see it. And it's only in sales. There's no service revenue in this. I think a previous example we had service revenue for Sonic Gate, but this one we just have this revenue from sales. So we sold products, $12,000. We have expenses which are totaled up here, and this is $8,900. I think you can see that. 78 and 6 is 84, and 84 and 5 is 89. So 8,900 for the expenses gives us 3,100 in net income. Our ratio of income to revenue is 25.8%. So 26% of all our revenue is something that we don't pay out in expenses. We get to keep 26% roughly of our revenue, which is nice. Now, net income, net NI in this thing over here is net income. You need to understand that net income is not cash. And the reason why net income is not cash is because we have all these timing differences. We record cash when it comes in or when it goes out. We don't always have revenue coming in and out when we don't always have cash and revenue happening at the same time. We don't have expenses happening at the same time as cash flow. So this means this first one is a true statement. Net income is not the same as cash. Also, net income does not reflect the change in value. At this earlier when we were talking about the balance sheet, I think we were buying land or real estate, and they told us it was worth, wasn't it $65,000 or something, but the transaction was for $60,000. So one of these concepts that we have is net income is really not the change in value. It's just that net income has to do with revenues minus expenses. And revenues minus expenses, that's not the same as value. It's just revenue minus expenses. The other thing is that net income is not really something that's exact. It seems like it is in this chapter, but when we get to it a little later, we'll understand this a little more fully. There are some things we just have to approximate. We estimate what expenses are in some cases. We estimate what revenue is in some cases. Okay, so that's the end of this PowerPoint. The next thing we'll need to do is look at